You know the feeling. You've been there, and you've set a stop loss at a level that seems totally rational.
You watch the price fall, it gets lower and lower, then bam! You're stopped out and like clockwork. And the very next moment, the price just rips higher, right back to where you thought it would go. It feels personal, right?
It feels like you were targeted. But what if it wasn't just bad luck? What if it was a trap set by the market itself?
Okay, let's really get into this. Because that feeling of being hunted, it's not just in your head.
You know the feeling. You've been there. You set a stop loss, at a level that seems totally rational. You watch the price fall, it gets lower and lower, then bam, you're stopped out. And like clockwork, in the very next moment, the price just rips higher, right back to where you thought it would go. It feels personal, right? It feels like you were targeted. But what if it wasn't just bad luck? What if it was a trap set by the market itself? Okay, let's really get into this. Because that feeling of being hunted, it's not just in your head. Now, the market isn't a person, of course, but it is a machine. And under very specific conditions, that machine becomes a predator. Your stop loss, the one thing you're using for protection, well, it becomes the bait. Today, we're going to pull back the curtain and show you exactly how this hunt works. So here's the game plan. We're going to start by looking at the trap itself. Then, we'll uncover the market's two completely different personalities and the hidden force that usually keeps everything stable. We'll pinpoint the exact moment it all flips, see why your stop becomes fuel for the fire, and, most importantly, we'll give you the new rules of engagement so you can navigate this whole thing. All right, so let me be crystal clear about this. If you've been getting stopped out over and over again during those crazy volatile times, only to watch the market immediately reverse, I'm here to tell you you're not crazy. It is not a coincidence. It's actually a structural feature of the market, not some random bug. And just understanding this one thing is the first step to avoiding the trap completely.
The key here is you've got to change how you see the market. Stop thinking of it like a personal fight. There isn't some trader in a skyscraper hunting your specific position. No, instead, picture a huge, powerful river carving its way through a canyon. That river is just following physics, right? It's looking for the path of least resistance. Well, in volatile markets, all those clusters of stop-loss orders, they create this deep, powerful channel that the market is just mechanically drawn right into.
Now, to really get how that channel gets carved so violently, you have to know that the market has a split personality. It doesn't play by the same rules all the time. There's a switch that gets flipped. And that switch is controlled by the VIX, specifically right around the number 25. That number, that is the line in the sand. Let's just quickly get on the same page here. The VIX is often called the fear gauge, but honestly, it's way more accurate to call it the uncertainty gauge. It comes from options prices. When traders are willing to pay more for options, which are basically insurance, it means they expect bigger price swings. The VIX just measures that expectation. Think of it as the market's speedometer, not its GPS. It tells you how fast you might go, not where you're headed. This slide just lays it out perfectly. When the VIX is chilling out below 25, the market's in what we call a stable regime. It's that gently flowing river. Price moves are pretty orderly because there are these powerful forces acting like guardrails. But once the VIX punches above 25, the market's entire personality changes. That river becomes a raging ocean storm. And the scary part is, the guardrails don't just vanish, they actually start pushing you over the cliff. So what are these guardrails I'm talking about? Well, in that calm, sub-25 VIX world, the market has these incredible built-in shock absorbers. And this whole system is driven by the biggest players out there, the market makers, the big dealers. And it operates under a condition known as positive gamma. Just think of the big dealers as a massive insurance company. They sell options to people like us, which is kind of like selling insurance policies on the market. Now, their main goal isn't to bet on which way the market's going. It's to stay neutral and just collect the fees, the premium. And to do that, they have to constantly hedge their books by buying and selling the actual stock. In normal times, this hedging is the single biggest reason the market stays stable. And here's exactly how those shock absorbers work. When the market price starts to drop, dealers are forced to buy into that weakness just to keep their books balanced. All that buying creates a kind of floor, it cushions the fall. And on the flip side, when the market rallies, they're forced to sell into that strength, creating a ceiling that slows down the rise. They are a counterforce. They literally buy the dip and sell the rip, and that keeps the market moving in an orderly way. This is the positive gamma state. But what happens when uncertainty spikes and the VIX crosses that magic number? Now here's the part nobody tells you. The market's shock absorbers, they don't just break, they literally turn into their exact opposite. The brakes become the accelerator. This is the gamma flip, and it is the secret to, well, to everything we're talking about.
This number, 25. This is the key. Right around a VIX of 25, the entire structure of the market flips on its head. The pressure on those big dealers becomes so huge that their own models force them to completely reverse how they hedge. The force that once kept the market stable now exists only to pour gasoline on its every move.
This new, dangerous state is called negative gamma, and it is absolutely crucial to get this. This is not a choice. The dealers aren't suddenly becoming evil. They are mechanically forced by their own risk models to do the exact opposite of what they were doing before. To stay neutral now, they have to chase the trend. They have to sell as the market falls and buy as it rises. I mean, look at this. This slide just shows the insane difference. Below VIX 25, in positive gamma, dealer hedging means stability. But above VIX 25, in negative gamma, it becomes a violent force for acceleration. They sell the dip, making it crash even harder. They buy the rip, making it squeeze even higher. The market shock absorber has just turned into a rocket engine.
So, now we've got a market that is mechanically wired to accelerate, right? And what does an accelerating machine always need? Fuel. And in the market, that fuel is liquidity. This is where we connect this big abstract idea to your very real, very painful experience of getting stopped out. This is the hunt.
I want you to pause for a second and think about your last few stop losses. Where did you put them? Was it just below a recent low, under a big round number? You see, we retail traders, we tend to put our stops in the same predictable spots. And altogether, these orders create these huge flashing pools of sell-side liquidity. In a normal market, these are support levels, but in a negative gamma market, they're targets. The accelerating price is pulled toward them like a magnet.
And here is the death spiral. A small price drop forces dealers to sell, which pushes the price down even faster. This triggers that first layer of stop losses. Those stops are now market sell orders, right? So they add more selling pressure, which in turn forces the dealers to hedge by selling, you guessed it, even more. It's a vicious, self-feeding loop. The price just waterfalls down, eating up every last stop order in that pool, until all of a sudden, the fuel is gone. The selling pressure instantly evaporates, and the price snaps back with unbelievable violence. You weren't just stopped out. Your stop was the fuel for the machine that hunted you.
Okay, so that is the trap. It's impersonal, it's mechanical, and it is ruthless. But understanding the machine is the only way to avoid getting crushed by it. So let's talk about the solution. I mean, you wouldn't try to navigate an ocean storm with the same map you use for a calm river, right? You need a whole new set of rules.
So here it is, your high VIX playbook. First, and this is non-negotiable, you have to cut your position size. I mean, drastically. The risk is just too high. Second, that tight little stop loss is now a huge liability. So you either need to widen it to a point that feels almost uncomfortable, or even better, use options to define your risk. Third, stop chasing breakouts. In this kind of market, they are designed to fail. Just be patient, volatility always comes back down. And finally, the most important mental shift of all. Stop trying to predict direction and start focusing on managing volatility. That's how the pros play this game.
And this right here, this is the single most important idea I want you to take away from all this. Your analysis of where the market was probably headed, it might have been spot on. But that doesn't matter if you don't understand the hidden plumbing of the environment you're trading in. You weren't wrong about the trade. You were just on the wrong side of the market structure. So, from now on, when you see the VIX starting to creep up towards 25, you're not just going to see a scary market. You're going to see the entire game board changing right under your feet. You'll know the shock absorbers are about to become accelerators. You'll know the hunt is on. So the only question left is, now that you know the rules, how are you going to change your game?
Secure your edge. Click subscribe to master the professional side of the trade.